Okay, let's go ahead and go through the solution to question 6 for the midterm review. This is the change from the cost method to the equity method to control. So a big company made several purchases of little company stock over the years. Assume all of Little's assets and liabilities are fairly valued, so any differential would be attributed to goodwill. In other words, you don't have to worry about amortizing anything. And we bought some shares on January 1st, 15, some shares on July 1st, 15, some in 16, some in 18, and then we sold some in 2019. It says assume that Little has earnings of $100,000 per year and pays dividends of $20,000 per year. Income is earned evenly throughout the year, and dividends are paid half in April and half in October. So for the dividends, $10,000 in April, $10,000 in October. So let's go ahead and go through these transactions. First, our initial investment. We bought 10% of the stock for $100,000 using the cost method. Nice and neat. Just record investment in Little, $100,000. April of 2015, we get our first semi-annual dividend check. We own 10% of their stock, so we get 10% of that $10,000 semi-annual check. On July 1st, 15, we buy another 5% for $60,000. So again, another $60,000 to the investment in Little. And then in October, we now own 15% of their stock, so we get 15% of the $10,000 semi-annual dividend, and that's investment income since we're using the cost method. January 1st, 16, we buy another 15% of their stock, so our ownership is now up to 30%, and we're going to need to switch to the equity method. So first, to record the investment in the usual fashion, debit investment Little, credit cash for the acquisition cost. And now we need to look at the change in method from the cost method to the equity method. And again, what we want to do here is make it appear as though the new method had always been used. So we're going to go ahead and make a cumulative, retroactive, or retrospective adjustment to retained earnings to reflect the difference in the earnings that would have been recorded under the equity method versus what was recorded under the cost method. So under the cost method, we had shown earnings of $2,500, $1,000 in April, $1,500 in October, total investment income or dividend income, $2,500. If we had used the equity method, then for the first half of the year, again, they make $100,000 per year, income is earned evenly throughout the year. So for the first half of the year, they would have made $50,000, and during that time frame, we owned half of their stock, 10% of their stock. So 10% of $50,000, $5,000. Same thing for the second half. They've earned another $50,000, but now our ownership is up to 15%. So if we had been using the equity method, we would have shown earnings of investment income of $7,500 for the latter half of 2015. So if we'd been using the equity method, the total earnings we would have reported would be $12,500. We actually did report $2,500, so we need to go ahead and adjust retained earnings to reflect the additional income we would have had if we had used the equity method. So we're going to go ahead and increase retained earnings by $10,000 and debit the investment in Little for $10,000 as well. Okay, 2016 and 2017, nothing else happens. We receive our semi-annual dividends. Again, we now own 30% of their stock, so 30% of $10,000 in April, 30% of $10,000 in October. And we receive, or at the end of the year, they report earnings of $100,000. We own 30% of their stock, so we report investment income of $30,000. 2017, the exact same thing happens. We record two receipts of $3,000 cash, one in April and one in October. That's why I wrote the little times 2 there. At the end of 2017, another $30,000 of investment income, our 30% of their reported earnings. Now on January 1st, 18, we buy another 30% of their stock and attain control. Now up until this point, we already owned 30%, and now we're buying another 30% to getting us up to 60% ownership. Now, when we attain control of a company, we're going to go ahead and revalue our existing investment up or down to fair value. Now, we just bought 30% for $600,000. That certainly implies that the 30% that we already owned is also worth $600,000. If you were to make up a T account for the investment in Little, you would find that it has a balance of $343,000. And again, that's our initial investment our second investment, our third investment, the change to the equity method, dividends received, income, dividends received, income. So the balance in the investment in little is $343,000. We're going to write it up to $600,000. So we're going to go ahead and show a gain on investment of $257,000, simply writing up the investment to its fair value on the date when we attain control. So again, this is one of the few places where we can show a gain or loss, as the case may be, simply by buying something. So now we have a 60% ownership share on the books at $1.2 million. Again, now we're back to our usual pattern. April and October, we receive our 2 semi-annual dividend checks. So in April, we get 60% or $6,000 out of the $10,000 total, and the same thing in October, another $6,000. At the end of 2018, we report our share of Little's reported earnings, 60% of $600,000 or $60,000. Now on July 1st, 2019, we're going to go ahead and sell a good chunk of our portfolio. And I wasn't entirely unambiguous, and it wasn't intentional, I assure you. It wasn't entirely unambiguous the way I wrote this. It said sold 50% for $800,000. Now, what I had originally intended by that was that we were going to sell half of our portfolio. If instead you thought, well, I own 60% of their stock, I'm going to sell 50% of that 60%, then you'd be selling 5/6 of your portfolio. So that could have been interpreted either way, and that's neither here nor there. It's the principle that counts. Basically, we've got an investment portfolio that is now, again, our portfolio value is $1.2 million. That was the value on January 1st, 18, minus the dividends, plus the income. So our investment portfolio has a balance, 200 minus 12 plus 60, of $1,248,000. Half of that, if we're going to sell half of our portfolio, that means we're going to sell half of that investment. So we're going to go ahead and get rid of half of our investment portfolio. We're going to receive $800,000 for it, and we'll have a nice little gain on sale of $176,000. If alternatively, and again, there's the question could have been interpreted either way. If instead you assume that we sold 50% of the 60% of the stock we own, in other words, if we sold 5/6 of our portfolio, then obviously the credit to the investment in Little would be different. Again, our investment portfolio had a value of, I keep losing track here. It was 1.2 million minus 6 plus 60. Our investment portfolio had a balance of 1248, and if we sell 5/6 of that, that's $624. Sorry, that's $1,040,000. I obviously copied and pasted and didn't update this before I started talking. That's $1,040,000 of the investment portfolio that we sold. We sold it for $800,000, and so we would have a loss on sale of $240,000.